Okay, let's do it. Can everybody see the screen?
Yes, we do.
Perfect. So, of course, what we're going to do is we're going to kick right off. You know, of course, as Evelyn said, this is a workbench to just give you an insight into access to finance. Ladies and gentlemen, I'm not here to actually literally show you how to raise funding, because raising funding there's not a skill to it. It takes two main aspects when you're raising funding. One is network, and that is number one. And number two is understanding who are the investors given my company's stage of growth and given what my company is doing that I need to approach in order to raise funding. There is no skill to it. The minute you understand these two verticals, which we hope that we're gonna share with you today, it is much easier for you to actually correlate where you need to find funding rather than spend days and days and days running after the wrong type of investor. Because running after the wrong type of investor is the worst thing a company can do. Because firstly, the investor already says this person has not done their homework. So why am I even gonna bother looking at their initiative? So it is absolutely critical that you understand who the investors are, and given the stage of growth, who am I going to approach for this money? So that's what we're gonna get through today. I think sometimes people get confused when you talk about access to funding. They think you're gonna sit here and tell them, okay, in order to get money, you need to do X, Y, and Z. It's not, it doesn't work like that. So as we go through this, please take your time to actually understand, okay, given what I'm trying to achieve and what I am being shown here, where is that alignment to my business? And with that, we're just gonna kick off. Of course, my name is Stanley Anyetei. I am an investment specialist. I have been in the investment game for about 20 years. I have been involved in impact investing for the last 15 years in structuring and developing new financial products in order to finance any type of entrepreneurs, including circular entrepreneurs. I hold an MBA and also attended the University of Cape Town. I'm actually a board member of Philips, the lighting company, and also sit on a few other initiatives like the Acumen Fund. I sit on their credit committee in order to help them actually invest in certain companies. And on top of that, I'm also a speaker and promotion for business solution and idealization to achieve inclusive growth. In short, I've worked for companies like Investec, and those are the companies that I've worked for. I've also participated a lot in the academic side of things. I'm the professor of sustainable development at Maastricht University. I'm also a professor of CSR at Tilburg University, which is also the TIAS Business School. And I also sit on the board of the Einstein Legacy Foundation, which looks to provide investment into educational initiatives. On top of that, I also engage in policy debates in order to ensure that the sustainable sector is being driven the right direction. Because as you guys all know, there is a lot of greenwashing in the whole sector. And one of the things that we need to actually ensure is that the people who are actually doing it are the people who actually get the funding. So that one of the main things is to actually speak at a lot of these conferences in order to ensure that the money is not always going to the same people, which I'm sure most of you are aware of. Like, you know, every single time there's an investment, it's always going to certain people, which is not right. So in short, this is me. When I give you the slides and you have any questions on any of this, I've left my email in the top corner. So please feel free to email me and we can have a discussion on any of those things. Currently, I work for an investment bank called Triodos Bank. And Triodos Bank is a normal retail bank that actually works across the whole continent. We work in South America, we work in we work in Asia, we work in Africa, we work in India. And what we do is that we invest in social companies. So if you are in any of those regions and you feel like, you know, you are looking for some form of funding, yet again, please feel free to contact us. Well, we are a developmental bank. And what I'll do is that in the slides, I actually told you about what a developmental bank invests in. So if you are aligned to what Triodos does, yet again, please feel free to actually contact me. Any questions so far? No? Okay, we're gonna dive right into it. Ladies and gentlemen, as we clearly state, the purpose of this workshop is to provide entrepreneurs with a solid foundation into what investors look at when they're looking at your company. Virtually, as an investor, there is certain elements that I hope that your company is got in order for me to invest in it, or I'm not gonna be able to invest in it. One of the main things that we're gonna do is that, of course, unfortunately, sorry, I need to move the camera so I can see properly. Sorry, give me 1 minute, I need to decrease. Unfortunately, one of the main things is that we're gonna talk about the introduction, which is connecting the dots, i.e., what do investors look for and what does my company need to have in order to be able to get investment. What we're gonna look at that, we're gonna look at the investment universe. Who are the different type of investors and what type of funding would they give you? In order to get funding, you need to be investor ready. And I'm sure this program that you're actually going through is to help you become investor ready. And at the end, we're gonna put it all together in order to actually connect the gap between investor expectation and company investment ready requirements. I also have a in the end, we have a 20-minute Q&A. And if you have any questions, I think at this point, please feel free to actually ask if you have any questions. So we're gonna dive right into it, connecting the dots. Where do they meet? I mean, where does the investor and the entrepreneur actually meet? And one of the things that we need to actually look at is that we are talking impact investment. And the important thing about impact investment is that it is investment to generate social and financial return. And that is one of the most critical things that you have to remember is that in normal investments, we are just looking at financial returns. But when it comes to the idea of impact investment, we are looking at social returns as well. Well, what is social? People call the word social as the consciousness journey of capital, i.e., let's say I'm an investor and I want to invest in order to improve the world, okay? There is so many different verticals. Right now, you guys are focused on circular economy, but don't forget, there's also education, there's also water, there's sanitation. There's so many different social challenges that investors can put their money. So virtually, when a social investor wants to invest in a company, what they'll look at is like, what do I find important? And how they look at that is that once they actually look at what is the consciousness journey of capital, they also look at business fundamentals. But let's start with the consciousness journey of capital first. Investor determines what is important to them. What do they want to change? Do I want to change the way that pollution occurs? Do I want to change the way that waste is done in the case of circular economy? Or do I want to change the way that animals are treated? When they decide what they want to do, and then they move to business fundamentals. Now, when you look at the business fundamentals, once they've decided, okay, fine, I want to invest in circular economy, they still want to ensure that the business that they invested in actually is well run. That starts with the leadership. That starts with the governance. It starts with your financial robustness. How strong is your company? And of course, it looks at your capacity and your operational process. I see the chat, so I'm gonna go. Please, if you have a question,
yeah.
Go on.
Yeah, no, that was me because some people came in a little bit later and I was just saying in the chat, but now I'll say it out loud as well. If you have like a question for Stanley, you can or unmute yourself or put it in the chat, okay?
Thank you, sorry about that. I'm taking the camera off so I can see my screen. So sometimes I have to like pause in order to open it. But yet again, as we said, once the investor is determined where they want to focus their investment on, you still have to have a strong business because it is an investment, not a grant. An investment means that I expect to get my money back. And hence, you notice that when you send your investment memorandum to any investor, they're gonna go through this with you. Now, of course, you need to find a balance, because at the end of the day, we are investing for both social return and financial return. So we do not expect you to have the same business fundamentals as somebody who is just focused on making money. So they need to have a balance. And this balance comes in as, like, you know, we're looking at impact reporting. Like, okay, at the end of the day, if this person says that, listen, I want to make sure that we decrease the amount of waste that goes into the production of, let's say, shoes, they want to know how much waste you want to decrease. If you want to decrease 1 ton versus somebody who wants to decrease 1,000 tons, of course, the money will go to the person who wants to decrease 1,000 tons, because they're actually much more strong. So when it comes to like social reporting, this is where it is important, and this is where the investors look for the balance. Of course, what determines the level of risk? Why would investors put their money into your company in order to make returns? Well, at the end of the day, it's about financial value creation. How much money is the company gonna make in the end? How much profit or loss is the company gonna make in the end? And ladies and gentlemen, this is the most challenging balance that investors have to go through when they're looking at social impact. Because I'll give you an example. Let's say I'm a company like Shell, okay? At Shell, if I am investing in Shell, I will not look on the left-hand side. I will not look at the conscious journey of capital. So I'll be expecting higher financial value creation. But if I'm investing in, let's say, what is that project? I always forget their name. But if I'm investing in a social company, of course, I'll say, okay, fine. I've got to find a balance, because although they are not strong in value creation, if I look at the difference that they're making in the world, I am happy with that number. So that means that I'm happy to put my money down. So it's one of the biggest challenges that we face as social investors, is finding the balance. Any questions so far? No?
Yes, there's one. When you're saying you want financial return, do you mean with interest or no?
You know, it's with interest, it's with equity returns, and it's also with, like, you know, for example, if I give you a recoverable grant is you paying back the grant once you become successful. That is also my financial return. So it's all about having the capacity to recover your money back. But then if I'm giving money to Shell, because of the mere fact that they're not a social company, I want them to recover my money back and make a much, much higher interest as well. But we're gonna discuss it much later when we talk about the different type of instruments that social investors actually invest in your company and the type of returns that they expect from you.
Okay, thank you.
Any other question?
Matt, yes, I do, but I don't know if this applies here or not. I'm just curious about the investment rate that investors expect of these projects.
We're going to talk about it as well, because it also goes down to the question that was asked a minute ago. And the investment rate actually really depends on the type of investor that you approach. You know what I mean? If you approach a philanthropist and they're going to give you program-related investment, the investment return that they expect is 0, but they want their money back. But if you go to a developmental bank like Triodos, we will expect like some form of interest, like 4% interest or 2% interest. And it all depends on the type of financial institution that you approach or the type of investor that you approach for the investment.
I see. Thank you.
No worries.
Well, 4% is really, I mean, here in Colombia, to get a 4% is very low. Well, we always are in the double numbers.
Of course. I mean, like, you know, in Colombia, unfortunately, if you look at it, I'm talking 4% in euros. But if we have to, because we actually invest in Colombia, but what we have to do is that we have to convert that 4% into local interest rates. So that means that we probably add on another 20% to that 4%, and then it becomes 24% in Colombian terms. You know what I mean?
Yeah, indeed.
Yeah. So
thanks, Matt.
It is very challenging.
Oh, yes, it is.
But you know what, the secret, and we're gonna talk about it later, is actually depending on where your company growth is. You know, going to a bank, if you're just starting out, is very stupid because they're gonna charge you 40%. But if you go to, let's say, a family office, they're gonna charge you 3% because for them, they don't really care that much about the return. They really want to see the type of difference you're gonna make. And that's where you go to the box on the left-hand side. A bank would just be looking on the right-hand side. You get it?
Got it.
Perfect. So,
thank you, Matt.
No worries. Let's move to the next section, which is closing the gap. And ladies and gentlemen, this is the most important slide because it is a summary of what we're gonna talk about now. Now, at the end of the day, investors, when they are looking at an investment, there's certain processes that they look at. And we're also gonna go through these processes individually, but this is just a summary for you to just get a hint of what we're gonna talk about. They look at the criteria alignment. One of the things that we talked about is that, listen, I am interested in investing in water and sanitation. That is my criteria. If you come to me with a waste company, that means that we're not aligned. So that is the first thing that you have to be careful about is that what type of investor am I approaching? Are they aligned to what I'm trying to do? They also look at the investment process, i.e. like, you know, at the end of the day, this is the company and how do we analyze this company in order to ensure that they mirror what we're looking for? We're gonna go through each one of these as well. Once the investment process is done, then they decide what type of investment product that they give you. This can be grants, this can be debt, it can be sub-debt, or it can be equity. So depending on looking at your company, depending on the stage of growth, depending on what type of company you are, and depending on what you're trying to achieve, they decide what type of instrument that they give you. Once that is done, of course, like we talked about, each instrument has a different type of return expectation. We're gonna talk about them later, but for example, when I give you a grant, I don't expect anything, it's zero. When I give you debt, I expect some interest, for example, but as I said, we go through that as well. And once you've completed this means that you've actually fulfilled the investment process, literally. Now, on the other side, a company needs to be investor ready before they can even approach the investment process. And what do you mean by investment ready? Well, if your business is in the idealization stage and you have not sold a product, it is very difficult to approach investors. If your business is in a stage where you are able to foresee your market and you know that, you know, once you get certain things in place, you'll be able to sell, then you can start approaching investors. So it is very important to understand what stage of growth your company is. And I'm sure through your master classes, you probably come across these things as well. Now, it is also good to understand your business strength. Ladies and gentlemen, if you are not making a lot of profits or you don't have cash on a monthly basis, it is very silly to go ask for debt because you know that every single month you got to pay interest. So if you are not making cash on a monthly basis, then your business is not strong enough to go for debt. You go for something like equity, for example, because you don't need to pay them on a monthly basis. We will also go through that later on to give you a better understanding of that. In order to determine how strong your business is, you got to look at, okay, we look at what type of market is this business in? What type of product are they selling? Who is the competition? How is the team? Who are the people who are actually driving this initiative? And of course, the last thing that you look at is the business performance. If you are able to actually show the investors that you are on top of all of this, it makes it much easier to actually raise funding. Because for me, as an investor, I kid you not, these are the only 5 things that I look at. I don't look at anything else. I really don't look at anything else. Because at the end of the day, if you have a market, that means that you can sell your product and people want your product. If your product is good and people in the market want it, that means that I'm going to recover my money because you are going to be able to sell your product. You know, competition is so important because of the mere fact that competition can kill your business. But one thing that we say in impact investing is that you guys as social entrepreneurs are what we call the feeder to the big companies, because your competitors actually can be your potential partners, because existing businesses do not have the innovation that you're bringing on board. So they would love to buy your company in order to absorb that innovation into their company. And of course, the team, critical, absolutely critical.
Stanley, there is a question.
Of course, please, go on.
Hi, Stanley. Thank you very much for the presentation. I have a question. You said one of the indicator of business strength is performance. And what this performance constitute of? Because when I see other items like the product, competition team, I thought these also refer to performance. Maybe I'm wrong on that. Can you please elaborate on the performance a little bit more?
Of course, and you're absolutely right, because when you look at the market, product, competition, and team, what that leads to is your potential profitability. And that's what we mean by performance. Because if you combine all of this element, if you have a market, that means that you can sell the product that you have into it. If the competition is not going to kill your business and you will have the right team members who are going to push the product, that means that you are able to sell your product in order to make profits. So when we talk about performance, we're talking about your revenue, we're talking about your sales, and we're talking about your profitability.
It is crystal clear now. Thank you.
No worries. Sorry about that. I think when we go, we're going to talk a little bit deeper into it. So then I think it will hopefully make sense in the end. I'm sorry. We're getting there. One of the most important things as well, ladies and gentlemen, is your funding requirement. For me, it is absolutely surprising that a company is got 100, let's say 100,000 euros in sales every year, and then they come and ask for €1 million in investments. It doesn't make sense. How do you intend to pay it back? So it is very, very important to understand the type of funding that you need, because ladies and gentlemen, it is so important to use this money for what it's supposed to be used for. Because if you take all this money and you're not able to actually grow the company with this money, you got to pay it back somehow. You have to pay it back somehow. So investors are they're not stupid, they're very smart. I know that if you're making €1 million in revenue, I can give you about 500,000, because at the end of the day, you are able to support 500,000 in funding. We also talk about how you actually know how much you should raise depending on the stage of your business growth. So we talk about that towards the end as well. And of course, you cannot approach any investor without a business plan. Then you're wasting your time. So when we talk about strategic document, you got to have a business plan or a business descriptor that actually describes your business to me. Because at the end of the day, I don't know your business. You know your business. So all these things that we talked about being investment ready, the investor will find that in your strategic document, and that is your business plan or your investment pitch. I'm sure you guys are going to do investment pitch once you're done, but this is part of what we call strategic document in order to make sure that the investor understands what your business looks like. Ladies and gentlemen, once you've actually gone through this process, you can see this is where the investment versus business readiness, this is how they meet. And once you've done that, you shouldn't have no problem in finding the right type of investor to raise money from, because you understand your investor and the investment process, and you know that your business is ready to actually approach investors. So this is what we're going to talk about today. Any questions so far? No. Now, the important thing is identify who the investors are. Now, of course, in impact investment, the good news about impact investment is that there's a whole lot of investors. I mean, there is a whole lot of investors. There's the foundations. There's the foundations, which are like, the NGOs. There is the family offices, the high network individuals and family offices that actually want to give towards social good. There's also mass retail. For example, you guys are all based in the Netherlands, right? Or are some people based in different countries? You're based in the Netherlands yet? Shake your head if you are. Perfect. Now, if you look at it, do you guys know that companies like Albert Heijn, H&M, and all of those type of companies, have a family office, which actually invests in social development. Do you guys know that? So if you look at it, mass retail, because of the danger that they put their environment in, all of them have actually set up a family office, which they actually invest in new technologies. For example, if you're a circular economy or a circular type of business, think about it. H&M and Albert Heijn, for example, are some of the biggest polluters when it comes to their supply chain. So they actually invest a lot of money in the circular process, but they cannot do it in their traditional business because they are scared to get it wrong. So they'll do it through their foundation in order to actually support new innovations in the circular sector to bring into their business. So if you're looking for funding, please also look for these people. They are quite an important side of it. There's also companies.
Matt, could I ask you something about these mass retail, this mass retail group? Because I also saw like something from the H&M Foundation. I think they had some competitions which you could take part in, you know, and you could get some funding through that as well. But when I saw it, I was like, I'm not gonna give H&M any knowledge about my business like that. Like I'm not gonna give that to them, you know. Like I don't want them, like, you know what I mean. Like I have a fear somewhere where like they might then just take that and like, okay, nice, we will use that now, basically.
Do you know, you've actually raised one of the most fundamental challenges that we have as impact investors in this sector.
Okay.
Because let me give you an example, okay? Now, if you look at H&M and Zara, they are such big institutions that, you know, their impact on the environment is absolutely massive. I mean, if you look at Unilever, there's one product of Unilever in every 5 homes in the world, okay? Now, if you have a new innovation, right, which is able to disrupt the market, they have got the infrastructure to actually scale it very, very quickly and make a much better and impact much quicker. The difference is that it is how you actually negotiate with them. Like, for example, do you guys know that Ben & Jerry's, you know the company Ben & Jerry's? Ben & Jerry's, the reason why Unilever bought Ben & Jerry's is that they wanted to absorb the supply chain activities of Ben & Jerry's into their operations. And that, to this day, is what is made Unilever the #1 sustainable supply chain in the world, because of Ben & Jerry's. And for us, it is also so important because at the end of the day, you as an entrepreneur come up with something special, which you also want to leverage on. But if you look at H&M, they are so big that they can actually kill you as a competitor. You know what I mean? So right now, we don't know what is the right way to look at it. Do we say, oh no, listen, sell it to them so they can create mass impact? Or do we say, listen, you have something special here, you can try and grow it? Yeah, you know, it's at the end, it's your decision. You know what I mean? It's how fast you want to make an impact or how slow you want to make profits.
Stanley,
Yeah, nice. Yeah.
Go on, Benny.
Hi. What do you know what they expect back from you? Like how transparent do they want you to be with your information? Like just secrets?
Do you know what? At the end of the day, don't forget. Sorry, go on. I'm being rude, Danny. Go on.
No. It's just I have the same feeling as Daniel, and I'm just wondering. I think a couple of weeks ago I read an article. I don't know. I think it was about Zalando, and it was about this topic. And the company which had the investment, they just stole the idea and just ran away with it.
Yeah. Never do that. I mean, and before you give them, because we call it the black box, okay? Before you give them the black box, you have got to have signed a contract that says that, listen, Unilever or H&M, I'll give you 30% of my company, and in order to actually, for you to support me scale this business. Because in the end, it's gonna be also helpful for them. So you must never ever give them the secret sauce until you actually understand what you're gonna get from it. Because if you tell them like, listen, I have found a new way to minimize waste, that in itself is good enough. But then before you actually ever give them any of the secrets, there has to be a contractual understanding and a signed one before you do anything like that. You need to protect yourself.
Okay.
Very critical. Never don't ever believe them. I'm not lying to you. When a mass retailer comes to you, it's like, don't worry, let's just get it done. And I promise you, oh, my friend, you will be surprised what will happen to you in the end. So the minute you get there, it's like, okay, fine. This is what we can do. First, we're going to sign an NDA. And secondly, once we've signed that NDA, we're going to talk about it. Because I mean, also, in order for them to get excited, you need to give them something. You know what I mean? So in signing the NDA, you can protect yourself. And also when we talk later on, like, you know, patents and IP and all of that, you have to ensure that you have protected yourself before you even open your books to those guys. Because me, myself, I don't trust them either.
No, I would never bring my money to them, but I just was curious about what they expect from you in the transparency.
Cool. You know what? They will expect you to open your black box. And the minute you open your black box, they're going to run away with it. There's no doubt.
Yeah. So we do understand each other, Matt, if I see it that way. So like the fears that we were having are very justified, right?
Of course. Of course.
But I do hear your argument. I think it's interesting. I've also considered it myself, but they do have a lot more capacity, of course. So you can argue they have they are way more positioned to increase the impact of whatever we are doing. So there's a balance there.
Yeah, but and that balance is what makes you an entrepreneur. You got to find it.
Yeah, nice. Thanks.
Perfect.
Yeah, that's a very interesting discussion. I just have a question about this discussion. Like there is in circular economy, the whole ideology is also knowledge sharing, open source, this kind of thing. This is the only way to bring scale to change the world sufficiently fast enough, right? What do you think about that? Is this complete nonsense, or how do you manage this kind of thinking?
I think it's nonsense. I'm not lying to you. I think it's nonsense. Whatever public money is funding is open source. But whatever you are privately doing yourself and killing yourself day and night to actually develop is stupid to make it open source. Do not be fooled about that. If the government is giving you millions to develop a certain vertical, then it has to be open source because government money is public money. It belongs to everybody. So it should be open source. But you guys are entrepreneurs that are struggling day and night to actually come up with an ideology that you are able to create value out of. You know, when you are fighting day and night, you don't hear people coming to you, it's like, oh, okay, let me give you free money and things like that. Of course not. And that's why we're sitting here talking about investments, because you are going to get investment to actually do this thing, and nobody's coming to offer you free money. So no, don't listen to that nonsense, because they say it's open source because of the mere fact that they want to sit back and enjoy themselves once somebody is actually done the hard work. It's not open source. If it was open source, they will also provide their company activities for free. That's the question.
Thank you.
Just a quick question, and we probably also really have to move on from this topic soon, but it's just very interesting, right? This balance between like investing and like sharing information, which like Thomas really like highlighted properly, like is like we say the new way of doing it, but then the side effect of like you don't want to give people your black box. So like one thing I had been thinking of for our company, what we could do is like we are thinking of developing some methods that could potentially, you know, could be intellectual property, and we should like defend it as such as well. But is there an argument to make to say like I'm going to make it our intellectual property, but I'm still going to make it open source so that I know it's mine, right? Like I know that there's not going to, because I feel like that's the main dumb part about, you know, like making something and then first making it open source without defending it for yourself is like another company can just make it theirs and then run with it. Whereas if you own it but still make it to the public, is there an argument to make to go in that direction?
If you can find a way to do that, I think you would have cracked the code.
Okay.
No, well, I mean, that's it. Because exactly what we're talking about, like you said, like, you know, at the end of the day, you know, this is a social good. We want to share it. But yet again, it's also something that you've developed and you want to also keep some form of ownership around, okay? Yeah. So if you can find a way to actually keep your intellectual property as your own, but yet make it open source where whoever decides to actually run with that idea has to pay you some form of like royalties with it, that would be excellent.
Okay, some sort of licensing agreement or something like that with MBA case, yeah.
Cool. There we go. Because you guys, ladies and gentlemen, do not sit here and think that because this is a social initiative, it is free. Oh no, it is not. It is not at all. So don't have that, because don't forget, all of these guys who are going to invest in it, they're going to run with it and make money out of it, yes or no? So why must you make it an open source to them? So, I mean, if you look at the investors, these are the different type of investors that you can approach. But investors, they don't just give you money. There's channels of there's ways that they give you the money. They'll do it through corporate CSR. I mean, I'm sure you guys have heard about company CSR. They'll also do it through developmental banks like Triodos. We are a developmental bank. They'll do it through social investor networks. I think when you guys have your pitch event, you're gonna have a lot of social investors coming to listen to you. Most of those social investors belong to what they call an angel network, where they all come together and share the risk of investment. In the next slide, I'll show you who the different type of social networks are. But I used to work for a company called Pemwemic, which is a social investor network as well. Of course, you guys have heard about crowdfunding platforms, traditional banks, and of course, private equity funds. So the investors, they will not, the mass retailer will not invest himself. He or she will put the money in one of these verticals, and they will invest through those verticals. And the different instruments that they actually use to invest include grants, we talked about that, purchase orders. Does anybody know do you guys know what a purchase order is? Or should I explain it quickly?
I mean, I guess, I'm just guessing, like I say, but I would suppose like a purchase order is maybe that you would have an investor who says like the first 5 or probably a bit more, 50,000 shirts that you're gonna produce to me. So like that's a type of funding, but then they get something back as well.
Exactly. No, you're absolutely right. Some people forget that, because it is also quite important, because it gives you the money to actually start off, and it itself is an investment. Of course, loan guarantees, which is also sometimes very simple, because some people don't have the money, but they have assets. So they're like, listen, go to the bank or go to this person and go get a loan, and I'll guarantee that if you're not able to pay it, I'll pay it back. Simple as that. And of course, then we have the traditional ones, which are the loans. And sub-debt is what we call a convertible loan, but I'll discuss it later on, so don't get too bogged down on it. And of course, the last one is equity. So as you can see, we have the different type of investors, and we have the channel in which they put their money in, and that channel will give you the different instruments in order for you to actually choose what type of investment you need at a different stage of your business growth. Now, what we're gonna start off with that, we're gonna start off with understanding, okay, fine. Earlier on, we talked about return expectations, okay? Now, if you look at the return expectations, from the top down, if the foundations and family offices, they don't really require like commercial returns. And when I talk about commercial returns, it's like interest and things like that. They want to make sure that the money that they give you, you can apply it to their social program. But the lower you go in that investment profile, the more commercial returns that they expect. And you can see, if I give you grants, I don't want any returns. But if I give you equity, of course, I want a portion of your company. Does the slide make sense to you guys? Because I know it's very full, but hopefully, the way it flows, it makes sense, because the foundations are the ones who will give you corporate CSR, and corporate CSR is naturally will give you grants and things like that. And with that, there's no kind of commercial requirements. It's more program-related requirements. At this stage of your guys' company's development, you guys will probably start from their family offices down, rather than the foundations, because you guys have got much more of a business idea than a more like, I want to save the world kind of idea. Now we're going to talk about the different type. If we go back to the slides, now we're going to start with the left. Who are the investors, okay? Who are the investors? Well, we're going to start with foundations, which was the first one. Foundations offer you a combination of short to medium term funding aimed at specific impact area. So if you are a circular economy, like I said, and one of you guys actually mentioned the fact that you actually seen one of the retail companies offering support, naturally they will give you grants in order to promote their kind of impact areas. who are they? Well, they include companies like, sorry, let me move this again. Oh, I'm struggling with the camera. They include companies like Gain. I've given you examples of who they are, but of course, there is plenty of different foundations that you can approach. In Netherlands, you have the Doomed Foundation, which actually gives all type of companies, all type of grants in order to do their work. You also have the LGT Foundation, which I think is in Switzerland, but these are just examples. You can go on the internet and you can find plenty. Now, what do they offer? Well, they offer grants, they offer repayable grants, they offer loans, and they offer a convertible loan. And how much do they offer? Well, they'll offer you between 10,000 to 5 million. And that's what the foundation will offer you. And they will give you this money for a period between 2 to 10 years. Now, of course, what do they expect in return? Well, when they give you grants, they just want you to ensure that you use the money to foster the social mandate. And that is it. When they give you loans, they expect interest. And when they give you convertible loan, which is a subordinated debt, we'll talk about what that is later on. So just park that because it requires a little bit of a deeper explanation. They also expect interest. And what are the key benefits in going to a foundation? Well, tailor-made funding. They give you multi-year support. Like if they give you money for this year, you can always go back next year and ask for more. And the two main important things is that they also help you with capacity building, and they are very involved. You know, they want to know how things are going. And if you have any questions, you can always go back to them and ask them. So the whole thing is that, it is very difficult to get this type of money because it's free money. But if you are able to actually get it, you actually do have some form of key benefits that you can actually gain from it. Any questions on foundations?
Yeah, just a quick question. It's more an affirmation, I guess. First, it's a question in the chat, so I will just ask it to. I ask a lot of questions. Sorry to everyone.
Please go crazy.
I'm this kind of person. But someone asked if you're going to share the slides afterwards.
Yeah, of course. I'm going to give you. That's why I've written so much on it, because I'm going to share it with you, so you don't always have to call me to explain it.
Perfect. Yeah. And then a second question, just for me, I think, is about these foundations. Am I correct in assuming that for a startup, like going from the conceptual to the starting business phase, these are the first places you might want to look for funding? Like something like Triodos, for example, is something, if you're running for 3 years, you have a track record, then you might want to go there, for example. But for the start, you should try to get these channels and use their funding.
Bingo. And if we go back to the previous slide, these are where, when you're in the idealization stage, at the last slide, I'll break it down much better for you. But when you're in the idealization stage, these are the guys that you go to. When you are in the beginning phase and your cash flow is almost 0 to none, these are the guys that you go to. Because why? They give you free money. I call grants and repayable grants free money.
Right. And I guess they also believe more in the vision, right? So if you have a strong vision, they are much more likely to give, and they're less of course, the cash flow is also important, like balance sheets like that, but it's more is your vision really clear? Is that connected to what we believe in? Okay, here you go, do what we also believe in.
You're absolutely right. You're absolutely right. Go ahead.
Then in the Q&A session last week, they told us friends and family is the cheapest way to get money. So that's the first step. And then the second is, foundations.
Somehow it feels like you've been reading my slide, because later on we talk exactly about those, I call them triple Fs. Okay. So we talk about that as well, because that is exactly where you start. Because in the end, you must go to the people who are going to give you the free, not the free money, the people who trust your idea and your vision. Because people who trust your idea and your vision, they don't care about the money now. But the people who care about the money are the commercial kind of investors, where they're like, listen, I love your vision, whatever, I don't care about it, but just show me where the money is. So in the beginning, foundations, philanthropists are your best bet. But listen, let's not beat around the bush. These guys are very difficult to get money from, because the amount of application you have to do, it takes a while. And that's why people sometimes neglect these people.
I have a question about that too. Sorry to interrupt. that it was the right time. Like, how do you have insights about how long the negotiation is, for example, with philanthropists and foundations and with other investors?
We'll talk about it later on. I have a slide especially that tells you how long the investment process takes and from which investor and how long it takes.
Sorry.
With foundations, it can take you almost a year. And I mean, listen, let's be honest, within that year, if you're waiting for foundation money, how do you expect to pay for your expenses? And that's the challenge with them sometimes. Okay. So now we go to the family offices, and with the family offices, we talked about, like, you know, the Albert Heijn and the H&Ms and all those rich individuals who have got too much money on their hands and they want to prove that, you know, they can do something different with their money. So that's what the impact and family offices are. And what they do is that they offer you tailored and flexible funding for specific needs. They are willing to take the risk because, I mean, it's their money, it's their personal money. So they can do whatever they want with it. And they naturally invest in pre-revenue companies as well, all the way to mature companies. So family offices are one of the most flexible because it's their own money. And who are they? I mean, I mentioned Premimic because it's one of the companies that I used to head. So, I mean, there's also a lot of them around. There's Aquaspark, there's, ladies and gentlemen, I'm just giving you examples here, but please go on the internet and you find a lot more, okay? Now, what do they offer? Just like foundations, and you can see we've moved from grants and repayable grants. Now we're getting more commercial because they'll offer you loans, equity, and convertible loans. They'll offer between 25,000 to 5 million. And of course, the term becomes a little bit shorter as well, as you can see. Because the more commercial you go, the shorter the term, but the bigger the amount that you can get. It's a tricky situation. What do they expect? Just like anyone, they'll expect interest for their loans. Quasi-equity, they will expect interest. And of course, when they give you equity, like we talked about, they'll expect about 20 to 30% of your company. And for me, I'll be willing to give 20 to 30% of my company away in order to have the type of support and funding that these people will give me. Of course, the key benefit, like we talked about, is that they will be socially aligned. Like, you know, there is circularity capital in America, for example. If you're a circular economy company, of course, the person that you go and look for investment from is circularity capital because they're socially aligned to what you're trying to achieve. They also give you technical support and they also open their networks to you because don't forget, these family offices are led by very, very prominent individuals who are well connected in the business world. Okay. Now we're going to move on to the developmental banks. Now, developmental banks are like your traditional banks. Like, you know, if you look at ING, if you look at Rabobank, if you look at all those traditional banks that you actually see, the only difference is that they only invest in sustainability. So they'll provide you the same product that a normal bank would provide you, but they only care about sustainability. But like you said earlier on, I don't know who mentioned it earlier on, they prefer strong, mature company with long operational history. So you got to be, so for you guys, when you start making revenue and you are able to make cash on a monthly basis, you can approach them because of the mere fact that, you have to pay interest on your loans. I put Triodos, there's so many different types of banks. In Belgium, there's BIL. In Netherlands, there's also FMO. But these guys, I don't think are for you guys right now because you are still, I think you're still in the foundation and the family office stage. I'm just giving you an example of where you go to after your company is more mature. And as you can see, because of the fact that it's a bank, when you need working capital, when you need to finance assets, when you need long-term loans, these are the guys that you go to. Do you guys know what working capital and asset finance is, right? No? Working capital is an overdraft for your business. That's simply what it is. You know, like you guys have got a credit card. If you have a credit card, you have an overdraft. Working cap, and that's what they give you. So for your business, they'll give you a business overdraft. Now, if I talk about asset financial, If you want to buy, let's say, as a circular company, you might need to buy a machine in order to use the machine to actually operate your business. They will give you money to buy the machine because they actually look at the revenue that the machine is going to make in order to get their money back. And ladies and gentlemen, when I give you that slide, I give you about 2 months. For the next 2 months, you're welcome to come back to me and ask me any questions that you have on the slides, okay? Because I know that some of these things are technical, so you got 2 months. After January, I want to be free of you guys. Is that okay? Is that a deal? So if you don't understand anything, please come back to me. But developmental banks just operate like a traditional bank. And of course, they give you between 1 million to 15 million, and the term is variable. It can be 1 year, 1 month, 30 years, so it just depends. If you want to buy a house or a building for your business, you also go to them. Of course, just like the others, they expect the same thing, but the difference is that, like, they provide you a complete banking solution. You guys don't need that yet. Right now, what you need is initial investment to start your business. So I advise you to go to the philanthropists and the impact funds. Don't even waste your time with developmental banks here, okay? And then the last sort of investors that you approach is what they call angel investors. Now, angel investors can even be your dad, any person with a lot of money that they're willing to invest in. And they have unlimited flexibility, and friends, families, and fools falls within this category. I mean, there's a lot of angel networks that you can also approach. I'll also give you an example here. And what they offer is that they offer you loans, they offer you equity. And one of the most important things is the last one, pre-launch funding. If your product is not in the market yet, they believe your vision, like Danny said earlier on, they'll be willing to give you money to launch it. So angel investors are part of your friends, families, and fools. They also offer between 25,000 to 5 million. And of course, the term is there. Ladies and gentlemen, we're not going to go into detail about this because this is what they offer. Now, the one important thing that you notice about angel investors is that the ownership that they expect is much bigger, and they expect a board seat, i.e., they want to be your advisor. Because of the mere fact that they're putting their personal money in it, they want to make sure that what you're doing is what they like. And the one negative about these people is that they are the people that are going to make you mad because you want to do something one way and they might want to do it another way. And because they got 40 to 60% in your company, it's almost equal share. So you cannot say, no, I want to do it my way. And that is one thing that you have to keep in your mind, is that if you approach the friends, families, and fools, they are the ones who actually disturb you the most. So it is very, very important to actually keep that in mind. Although they're very flexible, they are the most difficult. Now, those are the investors that are currently in the impact space. Does anybody have questions on the investors? No?
Well, since no one else asked you a question, I'll just take another shot at it. Why not, huh? I was just thinking, for the angel investors, if you present it this way, to me, it seems like a non-preferred situation in most cases. Like, unless you have no other way to get pre-launch funding, just don't go to them. Go to anything else, basically, because that expectation, I feel like they just set then, and giving up such a big chunk of your business, that just seems, then you have to find the perfect angel investor, I guess, the person who exactly matches what complements you or something.
And that's why I said it could be your dad.
Yeah.
You know what I mean? No, I'm being serious, because what and some people might disagree with me, but I think the more personal an investment is, the more dangerous it becomes. Because it's they become too emotionally attached. And if you have a disagreement with somebody and it becomes emotional, that is when your business really suffers. It really, really does. So I think it's your last, it should be your last leg, your last leg, if you can go nowhere else.
Cool.
Okay.
Yeah, thanks.
Now we're gonna move into, one of the things that we talked about is your investment criteria. Do I match with, how do I match with the type of investor? We've talked about who the different type of investors are. Now I'll give you an example. For Triodos Investment Management, this is our investment impact areas. We invest in energy and climate. We invest in inclusive finance, which is banks. We invest in arts and culture. We invest in sustainable food and agriculture, real estate, and social responsible investment. Now, if you come to Triodos, your business has to fit one of these. If it doesn't, you're wasting your time. You get what I mean? So each one of the investors that we've talked about in the previous slides, they also have this type of criteria that they set for you to say that, listen, if you don't fit in here, don't come here. So it is very, very important to ensure that your business is aligned to the type of investor that you're going to, or you are wasting your time. Is it clear? Because I just needed to show you this so it gives you an idea. Although we've talked about angel investors and all of them have criteria that they actually look at. And the next thing that we're actually gonna look at is how they invest, the different type of instruments that they use to invest. Now, there's two ways in which an organization can finance its growth. The first one is internally generated money, i.e., your personal investment, the money that you use yourself. That includes friends, family, and fools. I call them friends, family, and fools. And of course, you guys talked about that. That is the first way that you can finance it. This is your personal money. The second one is retained income. Do you guys know what retained income is, right? Whenever you sell a product, you have a margin on the product, right? And you save some of that margin, and all the margin that you save, we call it retained income, because it is all the savings that you have, and you can use that saving to buy new machinery or new inventory. So that's retained income. So that is what we call by internally generated cash. Or you can also ask for external funding. And this is what we've been talking about in going to the different investors. This includes grants. It includes debt and loans. It includes sub-debt. We're gonna discuss all of this. And of course, it includes equity. The danger about equity is that it requires valuation. And at this stage of your business growth, you don't wanna do that. You don't wanna do that. Ladies and gentlemen, we'll be going for 1 hour and 10 minutes. Do you guys think you wanna take a 5-minute comfort break and then come back, or what do you wanna do? Yes, no. Okay, let's take a 5-minute comfort break. So, I mean, everybody is well, prepared when we come back, because I know I've been lecturing online for the last year and it gets a little bit cumbersome. So let's take a 5 minutes. So we come back let's make it 1:15. How's that? We come back at 1:15 because we can go through it. See you guys at 1:15. Yay. Are we good to go? Perfect. You know, we're exactly halfway, so it's good news. We're exactly halfway, so it's good news. Now, of course, now we've looked at, wait, I'm up. Can you hear me? I hope so. Yes. Now we've looked at the fact how you actually generate, how organizations can finance themselves. Now what we're going to talk about very quickly, and ladies and gentlemen, I have given you the slides, and I've given you quite a lot on the slides. So I'm not going to read out every single thing in the slide, okay? Like I said, I want to introduce you to the foundation of what these things are and what they represent. And if you got any questions, please come back to me through, and I'm happy to get on the call with you guys to actually discuss some of those things. So what we're going to talk about is that we're going to talk about the different type of funding instruments that investors actually use. And we're going to start with grants. Now, if you look at it, a grant is literally a non-refundable payment. You know, they give you the money, you don't need to pay it back. It is forgivable, and all you need to do is that you need to use the money to achieve a purpose. That's number one. Well, what is, as a company, what should you be using a grant for? Ooh, I need to move this. Let's move it here. What should you be using a grant for? Well, you use your grant for ideas, because at the end of the day, that's what you should be doing. In idealization stage, that's what you use the grant for. You use it to generate your idea, you use it to actually conduct feasibility studies, or you use it to buy your first type of inventory that you need. So that's naturally what you use the grant for. Now, what are the benefits of it? You know, you don't need to pay it back. You don't have to give anybody any piece of your company. And also it aligns the investor's values with your company. So if I'm an investor and I give you a grant, that means that I like what you're doing. And it's very important to actually understand this. What is the risk? It is difficult to actually get your hands on it. It is extremely difficult to get your hands on it. And it's very unreliable, because it doesn't mean that because you got in it this year, you might get it next year. Grants are very, very unreliable. And one of the things that we talked about is the length of time it takes you to get it. And that's what we mean by high search cost. It takes you forever to get a grant. So the main thing that you have to understand is that while you're generating your ideas, you don't have a lot of expenses. So you can actually fund yourself using your own money, and then you can use that same time to actually search for grants. Anybody have questions on what is a grant and what it's used for? No. Now, the next one that we look at is pre-sales. Now, we talked about it, is like, you know, customer financing. The thing is that as then customers, when you are looking for a person or a company that you're going to sell your product to, you can actually ask them to finance your goods and services before you actually finish it. Crowdfunding platforms are very good at this. Every single crowdfunding platform will actually finance you in order to develop your technology. And once you've developed your technology, you can actually give it to them as the sales. It is very, very important to actually also look for this type of funding. What is it used for? It's used for working capital management, i.e., if I want to test my product in the market, what better way to actually have somebody pre-finance my product? And if they like it, they can actually go out there and be your first, if I can say, early adopters who can actually go out there and market it for you. There's also benefit to it. It closes more deals. You're actually able to sell before you actually come up with a product. And it reduces the need for you to borrow money in order to go and buy inventory in order to actually sell. Because while somebody's already paid for your product before you actually need to make it. So I will advise you to really, really start looking in the market, especially people who are hoping to sell their idea or their product to companies, because this will be a very, very good area of funding for you. When you are looking to sell it to individuals, crowdfunding platforms play this role for you. So if you're selling it to companies, approach the companies. If you're selling it to individuals, consider crowdfunding platforms. Of course, there's risk. If you get it wrong, your reputation is gone. It's absolutely gone. And don't forget, somebody's actually paid you money, and that means that you need to perform. If you do not perform, you also have a chance of just killing your reputation. And as you guys know, in business, reputation, unfortunately, is everything. So of course, there is dangers to this, but of course, there is also benefits, as you can see. As I said, if you have any questions on these things, please raise your hands so we can actually talk about it. But as you can see, you can actually read it yourself, what it does and what are the risks to it. When it comes to, yeah, go on.
Sorry, I saw one of the risks is prepaid income.
Yeah.
So the way I interpret that when I'm reading is that when I do crowdfunding, I get a prepaid income because they are paying me for a product that they're not necessarily receiving yet.
Yeah.
Is the risk then that I'm not, like, I get income, I cannot make the products and I have all that money and I have to give it back, but I invested some, so I have like a debt basically. Is that the risk?
And you can get sued.
Yeah,
okay. And nobody wants to be sued. I mean, nobody wants to be sued. And when it comes to customer and financing, ladies and gentlemen, it's all about reputation. It's all about reputation. Because you can run away and, like, you know, just because a lot of crowdfunding campaigns have actually done that, where the people have just disappeared. But that means that you never start another business again. So that's the danger of that. And of course, we move on to debt. I'm sure most of you guys know what debt actually is, but you know, the whole thing is that one of the things that you got to remember about raising debt, ladies and gentlemen, is that the money that you're gonna use the thing or activity that you're gonna use the debt for should be generating income. You cannot use debt to pay your staff wages, because your staff in itself do not generate income. You can use debt to buy a machine, because your machine is going to generate income. So you can never, and please, this is very important. I cannot stress this enough. Never use debt to do anything but things that will generate you income. Let me give you an example. If you buy a factory is gonna generate income, because why? You're gonna make your products in there. If you buy inventory, your inventory is gonna make you income because you're gonna sell it and you're gonna get money from it. If you buy a machine, the machine is gonna generate income because you're gonna use the machine to make goods and services. Very, very important. Of course, what is the benefit? One of the main benefits is that you don't have to give your company away. And to be honest, I think that is the only benefit that the debt will bring you. It's the fact that you don't have to give your company away. It is also like, you know, your debt ends, your relationship with the individual ends when your debt ends. Earlier on, we talked about the angel investors when we said that, listen, at the end of the day, some of them can be really, really difficult to deal with. And if they've got equity, that relationship doesn't end. It's almost like an unwanted marriage, and an unwanted marriage, oh my word. I wouldn't know, I've never been married, but I hear that it's not the best thing forward. So the good news about debt is that the minute you pay him back, it's like, I'll see you later, we don't have to talk again. So I find it as a good benefit. Of course, there is risk. There's absolute risk. And the biggest risk is the fact that you have to make periodic payments. If your company does not make money in February, you still have to pay the interest. It is very, very important. And for us, that also comes down to your reputation, because what happens is that if you're not able to pay it, you get a bad credit score. And that means that you will never be able to raise debt very cheaply, or never be able to raise debt anywhere else again. It is very, very important to remember this. In order to get debt, you have got to use it for something that is going to use to generate income, because that income, that asset that you use the debt for is going to generate is what you're going to use to pay it back. If you used to pay staff, okay, and I mean, don't forget, staff, necessarily you think staff generate you income, but staff don't necessarily generate you income because they don't produce the asset that you sell. They work on it, but they don't produce it. They're actually an absorption of income rather than produce income. And the thing that you use to pay staff is equity. We're gonna talk about it in the next slide. You use equity and grants to pay staff, not debt. Because think about it. Let's say I take 100 euros debt in order to pay my staff for this year. I pay my staff, but yet, no product or services were able to be developed. How the hell is the staff going to pay that money back? They're not going to give you their wages back, are they? Very, very, very important to remember this point.
So Stanley, to lower the risk, you put it, you use it for something which generates income.
Yeah, simple as that.
Yeah, okay.
Simple as that. I'll give you an example. Like, people use debt. People use debt to buy. People use debt for their house, for example. Now, when you use debt for your house, what it does is that, how does it generate your income? Is that it actually saves you money from paying rent. And if you're not paying rent, what are you doing? You're indirectly generating income. Does that make sense? Because every time you pay your rent, that's money gone. You're never going to see it again. So if I bought a house and I'm using that money to pay down my house still remains my house, but I'm actually generating income because I'm literally saving indirectly.
A question about debt and something like marketing. Yeah. So marketing can potentially make you money, or it may not. So
yeah, but Andrew, if you look at it, marketing does not generate a product to sell. You know what I mean? Marketing is an intangible, and maybe let's rephrase it. Debt has to be used for tangible activity that leads to income generation. It's like staff and working. I call those intangibles because, I mean, you can market as much as you want, but if your marketing does not hit the right note, you don't have the income that is needed in order to actually pay for the goods. The thing is that you use the money the money that you use for marketing is your retained income. You get what I mean? Because that is this extra that you've made. And that extra you can use to actually push your company. And that's the retained income and equity. That's what you use for marketing. So it's very important to actually look at what am I going to use the money for before you decide what type of instrument that you are going to take.
Stanley, you said tangible, right?
Yeah.
What about software for a platform? It's not that tangible, but it's like a machine, right? Almost.
Oh, that is challenging one. Software for a platform is normally like, because I mean, software for a platform is normally equity. You use equity to do that because the software itself is the company's secret sauce. It's the company's secret sauce. Let's take an example of a software like, unless your software, for example, let's talk about Facebook, for example. Let's talk about Facebook. Their software is what they use to make their money. If Facebook software was not there, they cannot make any money. So if you look at it in those terms, then yes, it's generating them income. And that's what it comes to. But if I have to buy software to ensure that my company's process runs smoothly, that is internal generate. It's not generating you the money that you need to pay down.
Okay, so for a platform as Facebook, you could use debt, or do you recommend to use equity for that?
I'll use equity for that because if nobody uses your software, then there's nothing you can do about it. Okay. The thing with tangible assets is that if I make a glass and somebody buys this, that means that there's a market for it. That means I can keep making it and people will buy it eventually, even if I have to put the prices down. But if nobody uses your software, no matter how you change the pricing or anything like that, it's still not gonna do anything.
Okay, clear.
This is a tricky but important point. And listen, guys, ladies, if ever you're going to raise funding, okay, and when you decide, okay, I need to build my team, or I need to build my marketing, or I need to build my software, just make sure you read up on what is the best financial instrument that I can use in order to finance this. It's as simple as that. I call it the University of Google. If it wasn't for Google, I would have failed my MBA. So please use the internet to actually just help you better understand what you need to do. Because the whole point of this is to provide you the foundation that you can build on it when you can, need to buy something, and use the internet for more assistance if you can. Okay. Now, of course, equity is what we just talked about, is that it is provided to businesses in exchange for ownership. Now, equity is very, very important, because if you get the right partner, they can actually help you tremendously. They can open their network, they can share technology with you, they can actually help you leverage for additional funding. Because, for example, let's say you get equity from H&M. If you go to a bank, the bank is going to be like, oh, okay, so you work with H&M. Oh, okay, that's fine, because I know that this is a credible company that knows what they're talking about. So it is very, very important to actually choose the right equity partner. That is critical. What is it used for? Activity that is used to grow the business. Do you see the difference? With debt, it is activities that is used to make income. With equity, it is activities that is used to grow the business itself, not to make income. Like we talk about product development, new marketing or sales initiatives, and geographic expansion or strengthening the balance sheet. That is the main thing. Debt is to make income. Equity is to grow the business, because you don't need to pay this money back. So that means that you can use it for things that does not generate income in the short term. So it's very, very important to actually distinguish the difference. What is the benefit? Well, it's good partnership, frees up your cash flow, because you don't have to pay back anything on a monthly basis. So that means that you don't need to reserve cash flow for that. But of course, there is always a risk. You have to give up ownership. That's one thing. It limits your decision making. I mean, when we talked about angel investors, I mean, my word, these people can really limit your ability to be innovative. It also takes time and effort, because you got to find the right partner. So that takes you much, much longer time to decide what the right partner is. And of course, when we talk about possible tension with the entrepreneur, it's key. It's absolutely key.
Can I ask you something about equity? Because this is a very complex topic, I feel like, especially it's more when you maybe also make do an IPO or something, then it becomes even more as an important topic. But, they say that if you have more than 5% of a company, you are a majority shareholder. You have
when you have
a seat at the table. Sorry?
When you have 51%, you're a majority shareholder. But when you have more than 10%, you have a seat at the table. Normally,
okay.
Yeah.
10% it is. Okay, because it's maybe also very context dependent, I can imagine. But there's some indication that you can give what these percentages also mean, in the kind of power that an investor holds in the decision-making process.
If the investor has anything above 40%, he has power in the decision-making process. Mm-hmm. But if the investor holds between 20 to 30%, they just they have a say, but you don't have to listen to them. You get what I mean? The minute they hold more than 40, it becomes quite a contentious issue, because when the investor says, okay, fine, I wanna sell out, at 40% it's a lot of money to suddenly go and find somewhere to pay him back. But at 10%, you're yeah, here's your money, I'll see you later. So that is the difference. So it's very, very critical to actually understand how much you want to give away. My main yardstick is that if your company is between 0 to 5 years old, you never give more than 20% away. If your company is between 5 to 10 years old, you can think about giving between 20 to 40 away, because at that time you need more people on board to actually help the company grow.
Yeah, that's a really nice, thanks. That's a really nice explanation. Also, I like the thought process behind, if they have 10%, if they would choose to sell all their stock, could you buy them out or not? Would they kill your business? Deciding on that, how much power they have is a really good a metric as well. Yeah.
How much years was the second, and how much percentage?
Between I'd say between 5 to 10 years old, you can go between 20 to 40.
Okay.
Because that's when your business is really starting to take off. And at that time, you started to make cash flow. So you can actually value your company properly as well. Between 0 to 5, you're still trying to establish your business, and to actually get a valuation in that time, you are cheating yourself, because your business needs to be institutionalized before you can actually sell it at a good price, really. Because you have that history of performance, and it comes down to the performance again. You know, for me, my personal favorite, companies at your stage of development, I believe that you should be never ask for debt, never ask for equity, but you must always ask for what they call a subordinated debt or a convertible loan. This is the instrument that you guys should be asking for. Why do I say that? It is debt that becomes equity in the future. What does that mean? What it does is that, in the beginning, because you don't have any money, because you don't have any cash, what the guy would do is that they'll give you 100 euros, they'll give you debt, okay? And what happens is that you don't pay interest on that debt at all. What it does is that the interest builds up every year. And after 5 years, for example, the 100 euros debt will become 120 euros debt, okay? So after 5 years, your company would have had enough operational history to actually decide that, okay, fine, we can turn this debt into equity, or I can pay you back. Because after 5 years, you will have enough money to actually pay the person back. So that means that for the first 5 years of the debt, you don't pay any interest. You know, the interest just builds up, builds up, builds up. And then after 5 years, you can decide, okay, well, this business is quite strong. Do you want to be an equity owner? Or you're like, hey, listen, I've got enough money. I can pay you back if you want. It gives you time to decide what you want to do. But the good news is that you also don't have to pay any interest, because of the mere fact that you save that cash flow, and the money, the interest that you owe them just builds up, builds up, builds up. And for me, this is the type of funding that I always say that entrepreneurs should actually have. That's quite a cute kid. So this is the type of this is the type of funding that you guys should be looking for. And the good news about subordinated debt is that because you don't have to pay equity, interest, you can use it for anything. You can use it for anything. Because you don't need the interest. You don't have to pay interest.
So like, if I understand this correctly, is it then, I remember that you also have certain types of bonds, I think, which have like a time stamp or something, like, and by that time you get like an expiration date, and then you get like the money paid out if you still have like the bond by that time and it's valuated.
It's called a zero coupon bond.
Yeah, that's the one. Okay, cool. And it's actually the same idea then? Same idea.
But the difference is that with a zero coupon bond, you got to pay the money back. But with convertible debt, you have a choice. And the choice is what is so important. Because after 5 years, if the company does not have any money, the guy has to convert it into equity. Because he's got no choice. You cannot pay him. So, hey, you convert it into equity. It is the most important instrument. I believe it works for you guys. So right now for you guys, you're either going for a grant or you're going for a convertible debt. Does that make sense? Where's my clicker? Yes, that's my, oh no, my clicker.
Oh, one question though, because like I get that from our perspective, like this is the holy grail, right? Like, okay, this is really nice if you get it, but how keen are investors then on choosing this? Because they take quite a risk. I feel like if they must really believe in what you're trying to do.
Impact investors will definitely take this risk. Normal investors will not want to take this risk because they are more commercially minded. They want their money and they want to be sure that they have their money. But impact investors will take this risk because they also want to see if your technology works, because nobody's done it before. So they understand that, listen, this guy is coming up with something new that if he gets it right, this will shoot out the lights. So of course, I want to give him, I want to take equity if he gets it right. And that's why the name sometimes changes, because for traditional investors, they will give you subordinated debt, which is equity, but it's not really equity. But the price is different. The pricing is different. That's why you see that I keep using subordinated debt. I apologize. It should be convertible loans for you guys. For traditional bankers, they'll give you subordinated debt. So it's the same thing, but just called differently. What are the benefits? Like we said, cheaper source of funding. There's no immediate repayment. You don't require to value your company now because, I mean, you got to wait 5 years until you can value it. And of course, it's the same as equity because you also have a partnership with the investor because he's going to stay in for 5 years and then he could be your wife. It's almost like a prolonged engagement period. That's virtually what it is. You're testing out the waters. Of course, listen, there's risk, okay? Interest, like we said, is going to accrue over time. So, you know, you're building up more debt over time. You know, most entrepreneurs don't understand it. So sometimes it's very difficult for them to actually make the right decision on what are the terms and conditions that they should give their investor. Yet again, it is very important that you increase your knowledge based on that particular instrument. And I can assure you, when you read about it, it is as simple as it can be. It's not that difficult. So just make sure you just, when you're ready to go look for something like that, just read up about it. And as I said, yes, I hate doing this, but I am available to actually have a conversation on this thing and go deeper into it and explain to you what it entails if you would like to know more. You know, there's people that may be in the masterclass that really don't care about this, so I didn't want to go deeper into it. But if you really want to go deep into it, we can talk, we can take it offline, okay?
Okay, so should I just do that then? Because I do have another question about this.
Please ask, but we can go deeper later. But
okay, yeah, I mean, nice. No, just as a, like, just so I understand also like how it works in like the translation to equity. So like I meet a impact investor and I'm like explaining their vision. They believe in what we're trying to do. And they say, okay, I'm going to give you this convertible loan over, I don't know, 5 years.
Yeah.
And this is going to be a loan of 200,000.
Yeah.
Right. Is it then that after these 5 years, we're going to see how much that loan with interest is worth then, and seeing how much my company is worth by calculating how you calculate like share value as well, and then you decide how much equity they get. Yeah. So if I'm like kind of broke as a company, they just get all my shares and it's like, well, this is your problem now.
Yeah, or they can just extend, or they can just extend the period. But the thing is that there's one thing I haven't mentioned is that they get a discount. As I said, conversion usually at a discount. So let's say your is €1 per share. You normally the going rate is that you give it to them for 80 cents rather than €1. So they get a discount. But my friend, this discount you should be willing to give it because the benefits of this is far outweighs anything else. So don't even think about it. And the thing is that, like you said, at the end, if your company is worth nothing, they will not want to convert. They will like, okay, fine. We keep the same process for another 2 years, but then I'll increase my discount. But for you, it's okay. Because at the end of the day, if they were not there, you would have been screwed. So for you, it's okay. So I think that is the one caveat is that instead of selling it to them for €1 per share, you sell it to them for, and the maximum is 20%. Never give a discount for more than 20%. Some of them will take a 5% discount, a 10% discount, but never give a discount for more than 20%.
Nice, thanks.
Any questions?
Yes, just one more question to get it totally right. So after these 5 years in the example Daniel gave, you see at that moment like what's the 200,000 worth with the interest, and then the equity is in shares, or?
Yeah, it's in shares, because what happens is that, listen, after 5 years, you would have had an operational history. So it is much easier to value your company after 5 years. And then whatever your company is worth at that time, let's say your company is worth $1 million, okay? And let's say your the interest plus the debt is 250,000. So they will get what 40% of the company, for example.
Yeah.
So it's to you to actually build the company to have, you know, some of them will not convert everything, right? They will say, okay, fine, I'll convert 50% of it, and then you can pay me back debt of 50% of it. So it's much more flexibility. So they don't always have to convert 100%. Depending on how much money the company has, they can decide to convert a portion and take money out. Because listen, if I am an equity holder, I will never put you in a position that your company is going to suffer. Because if you suffer, I suffer. You get what I mean? So they will never do anything that will put the company to jeopardy, because now they also become equity holders. So, and indirectly, you psychologically actually trick them. That's what I call it. And impact investors, like I said, impact investors will do this because they believe that the technology that you are coming up with, or the idea that you're coming up with, is going to be worth so much more. Like, think about it. Before Facebook came into the picture, if you were able to put a convertible debt into Facebook now, when they first started, imagine how much your shares would be worth right now. And that is what impact investors are looking for. They're looking for the new Facebook or the new big thing. Because listen, let's be honest now, the next big unicorn and those type of companies are not going to come from the traditional sector. They're going to come from the sustainability sector, because now that is currently what everybody is talking about. And straight off, there is not new ideas that is going to come from the traditional sector. The next big thing is going to come from the sustainability sector. So everybody wants to take a punt. I mean, I've got 1 or 2 convertible shares. I also want to take a punt in something. Okay. And of course, you guys know what crowdfunding is. So I just thought that crowdfunding is the same. I mean, I'm not going to spend too much time on it, but you know, the whole thing is that you actually do crowdfunding in order to raise money. But for me, I'm not a big fan of crowdfunding. I'm a big fan of, like, you know, funding platforms, not crowdfunding, because of the mere fact that I think sometimes people lose the idea of what you're trying to do. But I mean, you guys, I'm sure, are very familiar with crowdfunding, so please feel free to do it if you feel like you can get something out of it. I'm not going to spend too much time on crowdfunding. I mean, I'm as an investor, I'm not a real big fan of crowdfunding because of the mere fact that I'm like, listen, if you really want somebody to respect what you're doing and really want to have the right partners, you need to find an investor that works. And crowdfunding is for only certain type of products. You cannot sell all your products, especially also in the circularity space. Crowdfunding could be dangerous unless you come up with a new idea, a new innovation. But the minute you go on crowdfunding, you open up the black box as well. Don't forget that. Which is dangerous, I think. Now, of course, you got to ask yourself, and ladies and gentlemen, I'm going to give you the slide. So we're not going to go through every single one. One of the things that you have to ask yourself is, does my enterprise need funding? Very, very important. And how do you ask yourself this? Well, first question, do you want to grow very fast to disrupt a market? No, do not raise money. If it's yes, you got to ask yourself, do you need significant upfront investment to buy inventory? Yes, raise debt or equity. If it's no, you know what I mean? So I've given you, we're not going to go through this because it's self-explanatory. So I've given you all of this where you know, it tells you when you should raise money and what type of money you should raise. For example, do you charge man days to your clients? And when I mean man days to your clients is if you're a consultant. But I don't think any of you guys are consulting. If the answer is yes, raise grant or sub debt, because, and that's, you notice how there's no debt here, because we are talking about man hours, for example. So I've just given you this slide in order to help you also determine, like, you know, do you need to raise funding and what type of funding that you need to raise. Sorry, let's go back. It feels like I'm going quickly, but you know, this is not, we don't need to go through this piece by piece. It's very self-explanatory. I just want to get through it because, I mean, we got the important slides is when we put it all together, and that's what I actually want to get to. And the question that we need to ask ourselves is, where do investors see value? I am not investing in your company for what it is now. I'm investing in your company for what the potential is on your company. And so investors never, ever look for value in your company today. They look for what you're going to achieve in the next 2 to 5 years. And this is very, very important. And that's why you must always, in your pitch document, which you're going to which you're going to do, or your documents that you're going to do, you must always provide a forward-looking, if I can say, explanation on what you aim to achieve in the next 2 to 5 years. It is very, very critical, because you can have a good company now, but if I invest in your company now and in 2 years' time, the company is going to fall apart, I'm not going to achieve anything, am I? If I invested in it 2 years ago, then I would have achieved something, depending on what it is now. So it is very important for you guys to focus on what are the key drivers. I'll give you an example of it. Like when you are trying to tell investors what you're going to achieve, the best way to do it is in a graph like this. Very, very simple. Tell them when you're going to break even, what is your target client in like 3 to 4 years, and how much money you're going to make in 3 to 4 years. Simple as that. This is one of the most important things that investors look at. What are you aiming to achieve? Because I will not know. I'm not in your business, but you got to explain it to me. You guys understand this? Of course, your financial statements are also important. But of course, what I'm going to do quickly, do you guys understand the financial statement, right? What I want to show you quickly here is what investors look at when they look at your financial statement and why it's so important. If you look at it, your income statement is your specific performance over time. Now, your net income that you make every year is what we talked about earlier on, is your retained earnings. Okay, now your retained earnings is how strong your company is. So every single time you make 100 euros and you save that 100 euros, what does it do? It grows your balance sheet, and investors want to see how strong your company is. Now, if you look at your cash flow, it's how much cash you burn in every month. Okay, now for investors, it's also kind of important, because if I give you 100 euros today and you burn it out in less than 2 months, that means that you need to go out and raise more money. So that means that, listen, if you're not able to raise more money, that means that, as an investor, I've wasted my money. So it is very, very important to actually show the investors, and they call it the cash burn. Now, what it does is that the more cash you make, or the more cash flow you make, it also strengthens your balance sheet. And these are the main things that investors look at when they look at your income statement, your cash flow, and your balance sheet. The rest are just noise. I'm going to be honest with you. The rest are just noise. These 4 things are the main things that investors are more interested in, because the more money you burn, the less cash you have, and that means that the company will not survive. So please pay attention to these 4 things when you are running your business. It is very critical. Any questions on that? Now, one thing that we talked about is that, okay, fine, what are the uses of funding? Now, at every level of your growth, for example, when you're talking about concept, proof of concept, startup, growth, and scaling, you need different type of money to do different things. When you're doing when you're at the concept stage, you're conducting your feasibility study. When you're at proof of concept, you're building technical capacity. At startup, you're trying to achieve break even, because now you're selling a product. So now you just need to make sure that you achieve break even. When you get to growth, you are acquiring equipment, and you want to grow your business. And of course, when you go to scaling, you're increasing your sales. Can you guys notice something? Because at growth, what are you doing? You are acquiring equipment, so you're using debt. At scaling, you are increasing sales, so you're using equity. And what did we talk about? If you look at convertible debt, the first 5 years, you are growing. After 5 years is when you actually want to look for equity. So one of the things that you have to understand is that at every stage of your growth, you require a certain type of money. So for example, your pre-stage, what you need the money for is that you need the money for prototype. You can only get 0 to 10,000. That is the type of money you must ask for. And what type of instrument must you ask for? Grants. Does that make sense to you guys? So at pre-startup, you haven't started anything. You haven't really sold anything. So there's no point getting debt. You don't have any cash flow. No point getting equity, because you don't have any business to value. The only thing you can get is grants, but don't ask for more than 100,000 because the guy will look at you and say, you're wasting my time. And when you actually start up where you guys are right now, is when you actually need money to buy inventory in order to be able to sell, you should ask between 0 to $1 million. Never ask for more. Because if you ask for more at a startup, then these guys think you're actually wasting your time. What are you going to use the money for? Is to achieve break even. I need to buy more inventory so I can sell more. So you can use grant, we can use pre-sales. Sub-debt is what we call convertible loans, sorry, or you can use equity. I've done it for you guys for all the different stages of your growth. So as you can see, at every single stage of your business development, there's a certain amount of money that you must ask for, and that money can only be used for certain things. Very, very important to remember that. Because if you're asking for 5 million at startup, you're never gonna get it. You are wasting your time. And it comes back to what we talked about when we started, is that people waste more time because they are looking for the wrong type of money from the wrong type of people. If you know what you need to ask for, from whom, 90% of your fundraising job is already done. It is very, very critical. So when I give you the slides, just understand what you need the money for, how much you need to get it, and where to get it from. Does everybody understand how this works? Yeah. It is also quite important to actually talk about how much you need. I'll give you an example. This is an example of a company that was looking for money, and this is how they actually phrased it. Now, when you go to a company to ask for money, you got to understand this is the type of things that you need. Okay, how much do I need? What are the terms of the money that I'm looking for? And the most important thing is that, what am I going to use the money for? A company asked and was looking for funding, and this is how they presented it. For me, I read this in one page. I'm like, yeah, it makes absolute sense. Because I combined this with their milestone page. And I'm like, okay, fine. They need 1.2 million. And in 2 to 5 years, this is what they're looking to achieve. And you can actually put these two together, and it actually makes absolute sense. Because now you can see how much money they need, what they're going to use the money for, and what they're looking to achieve in 2 to 5 years. And investors, this is the connection that they make. If you are looking for this type of money, but you're saying that, listen, in 2 to 5 years, I want to be the #1 in the market, it doesn't make sense. It doesn't make sense. So you need to marry the two. It is very, very important for you guys to look at it like that. Anybody have questions on this so far? I think now we talked about the investment process. Oh my word, this is how long it takes, because when you actually approach an investor, the first, we call it pre-screening, because the investor will get thousands and thousands of business plans and things like that. And this is the pre-screening stage, okay? And then once they've actually gotten all of those, they actually select about 20 of who they want to speak to. This process alone, after that, okay, we're going to go through the whole investment process, and then we're going to talk about how long it takes. After this pre-screening, they actually select, if I can say, companies that they meet their criteria. After that, of course, then they will look at due diligence. They'll call you, and then they'll talk to you about your company. Once that is done, they will actually go through what we call an investor approval process, where they will actually take the, if I can say, your pitch and your business plan and everything, and they'll present it to their credit committee, okay? That will come in a short presentation. And then, of course, once they actually like what they do, they'll present you with what we call a term sheet. After the term sheet is done, then they'll get into the investment agreement, okay? The investment agreement talks about, like, the legal documents that you need to sign. Once the legal documents are done, of course, they give you the money, and then they give you ongoing support. And then, of course, later on, they'll look to exit. But listen, this is a rolling process. So it could go on for a year. But this process alone, due diligence will take you 3 months. The investor approval will take you another 3 months. And that process, and then of course, the last process will take you about what? Plus minus 5 years. Once you get the money, you'll be there for about plus minus 5 years. Now think about it. Before you even get the money, that's 6 months minimum. So imagine you approach the wrong investor. That means that you would have spent 3 months already with the wrong person. And then you have to start the process all over again. It is absolutely critical that you approach the right investor, because the minute you do that, you would have cut your process short by at least 9 months. I kid you not. And this is why I wanted to show you the slide, is that this is the investment process that investors go through. So if you get it wrong and at due diligence stage, they realize that this guy is not the person that we want to talk to, that is 6 months down the line, just gone. And that 6 months, you will be spending your own money in order to grow your business, and you are losing money because of the mere fact that you need money in order to make money. It's as simple as that. Any questions on the investment process?
I've got a question about, like, do investment companies and investors have like potentially yearly budgets? So is there maybe an optimum time to approach investors? Like if they're getting towards the end of that year and they have a certain budget to get rid of, your terms might be slightly easier.
Yeah, for grant investors, they have a yearly budget. For grant investors, it's good to approach them towards like February, March, because they do their yearly budget at the end of the year. And that means that they say, okay, fine, at the end of the year, we have 100 million to give away, for example. And then in January, if I were you, I put my thing in January. And then that you'll be one of the first in the queue. But for traditional investors, it's a rolling process. It's a rolling process because they have a bucket of money, and don't forget, people also paying them back. So they can reuse that money that you're paying back in order to actually reinvest it. So think about it. For grant providers, they do their budget at the end of the year. So you want to be there first, January, February. But for any other investor, it's a rolling process. I want to get to the last slide. I mean, let's just move to the last slide, because I think this slide is actually more important than the documentation slide. So let's actually do this. And I think that is the last slide. So now we're going to put it all together from every single thing that we've talked about today. We're going to put it all together. And in putting it all together, we talk about the stage of business, right? If you are the seed stage, which is like, you know, there's different stages. You have the seed stage, you have proof of concept, startup, growth stage. Now, at each stage, you need the money for something. At seed stage, you're conducting your feasibility study. At proof of concept, you're building technical capacity. At startup, you're achieving break even. These are all the things that we've discussed. Now, the financial instrument that you need at each stage, for example, from seed to proof of concept, you can use the triple Fs, friends, families, and fools. You can also use grant from seed to start up, and you can use convertible debt from seed all the way to the end. And of course, debt, we talked about the fact that you need debt to only acquire revenue and an asset. So you use it from startup forward. Never use debt from startup to the left. And of course, equity, you can only use equity once you start making money. One of the things that we didn't talk about, which I'm glad that we didn't talk about, is valuation techniques. But usually, at every single stage of your development, there's valuation techniques that you guys will use. But I didn't touch on this because your company will never get there to this point. You only start doing that after you've earned money for 5 to 6 years. I wanted to touch on this because if I give you the slide, you're actually going to see it. And literally, that is virtually it. So in summary, I'm going to put it all together. It's been quite a long, I've talked for too long, so it's time to actually put the brakes on it. In summary, the best time to seek funding is if you have existing customers or potential customers ready to buy your product. You are in the stage of development when outside shareholders are able to add significant value to the industry. You can only approach investors if you know that they can add significant value to your business. It's absolutely critical. they also provide you with knowledge, connections, and mentorship. You have to be 100% committed to the enterprise. Because if you're not 100% committed, the investor will never ever put money in it, because that means that they do not trust your ability to ensure that they get their money back. It is very important to do so. And like we talked about, milestones are important. Very, very important to demonstrate the business is likely to grow rapidly over the next few years, because that's where the investor is going to get the money from. And ladies and gentlemen, that is it. Yay! That is virtually what the masterclass is all about. It's literally just a foundation to just let you guys understand that looking for money, there's no special skill to it. Just make sure you understand the stage of growth of your business and what you need the money for. And it is so much easier to do it. But thank you very, very much for your time, and I'm open for questions.
Thank you very much. It was really nice, very clear, very dynamic. Thank you very much. Very insightful.
Yeah, thanks a lot. Like, I really got to give you like props. Like, this is, I think, been by far the most engaging virtual lecture I've had so far. Like, it's really not easy, you know, to really give people the feel that like they can interact the whole time with you. And like still make it interesting. So you said like I was talking for a long time, we gotta end it. But to me, I could have listened to you for a couple more hours. So like you really did a great job, I think. Thanks a lot for that.
Thank you. Evelyn, I give the floor to you.
Really good. Stanley, thank you so much for facilitating this. I'm very happy as well that we recorded it. In the chat, some people during our masterclass had to leave us, but like people personally gave me feedback on like how enthusiastic they were about you. So thank you really so much for making this, like, to be honest, like kind of like tough topic a little bit more fun, right, and understandable, and you are so straightforward that yeah, I think that it was a great energy. Yeah, I just want to one more time give the opportunity for people to maybe say something, ask something. Is there something that you want to voice before we go?
I think maybe the last thing for me is that, like I said, guys, for the next 2 months, I will share the slides with you. I'll PDF it and send it to you. And for the next 2 months, I am traveling quite a lot for work, but I'm always happy to get on Skype or Zoom or anything to answer some of the questions that you have. So please feel free to get back to me. I'm going to shut up now.
Great. Thank you so much. Thank you.
Really good. Before we leave, I actually already shared something in the chat. I actually wanted to wait with that, but I thought it would first upload and then it will be shared, but it is actually already in the chat. I want to give the word to Maiko, and Maiko is working for K+V. You leaving? No, you staying, Stanley, or are you leaving?
Should I stay or should I go?
Yeah, no, you can stay. You can also go, whatever feels good.
See you guys later. I am going to go and jump in the swimming pool. It's so hot over here, so I'm going to go swim. So I will see you guys later. Listen, good luck, and I look forward to hearing from you guys.
Thank you so much, Stanley. Thank you so much. Yeah, so then I really want to give the floor for the last few minutes, and then we will all go, because I think we are so full with information. By the way, I will share the slides and the recordings from Stanley. But Maiko is working for K+V and also working together with the province, and they offer, they designed a accelerate program, a program that is called PIM. And Maiko is going to share a little bit information on that, kind of like just a voice that it is available, and then you will find more information in the chat.
Yes, all right, thanks, Evelyn. So guys, I just joined a couple of minutes ago and I only saw the last slides, but to be honest, it looked great, because that is exactly what you need to know before you go out and seek for funding. But what I know is that seeking for funding and actually raise funding can be difficult. It's hard to get around it and to get in touch with the right investors and to be prepared as best as possible. So what I do, I work for a company is called K plus V, and we're running a program that is called PIM. And PIM is a initiative of the province North Holland that will enable young and early entrepreneurs to get prepared as best as possible to go and get a round of investment for a subsidized price. So we can offer low budget advice that is really hands-on and that helps you exactly with the things that I saw on the slides earlier from Matt to prepare you in the best way possible to get in touch with investors. So what we do, we first make the entrepreneurs investor ready, working on all the financial documents that are needed, the pitch deck, the business planning, the business case, everything that is needed to reach out to investors and actually convince them. What we also do is helping entrepreneurs with setting up a financial strategy. So how are we going to get this investment done? Looking at the investment landscape that there is at the moment, looking at the stage of the company. Are we a startup or are we actually in a proof of concept? What kind of instrument is best fitting our proposition right now? Do we look for equity or a loan or crowdfunding or more on the public side of the funding landscape? There are a lot of possibilities here. So setting up a good strategy is really important. And the last thing that we often do is do the matchmaking between entrepreneurs and investors. We do this a lot. We did it for 3 years, the last 3 years, and we raised 52 million out of the investment market for 110 entrepreneurs successfully. So that's why we continued this program since last June. We already raised 5.5 million since then. And helped a lot of entrepreneurs getting ready and get the first conversations with investors that they like. So the great thing about this program is that I don't have to sell it to people. I have to offer it in order to help entrepreneurs that are really in need of it and don't have the money to hire expensive financial advisors. So we are subsidized by the province and can offer this for a really low and affordable rate, so that all the entrepreneurs that are in this early stage don't have the financial resources to hire those expensive advisors to still participate in programs like this and still get their access to the financial market. So that is a really short summary of what we do. I don't want to bother you with all the details and all the side information around the program, but I just want to inform you that there is help out there. There's help from me and the whole team that's behind me. A lot of ex-entrepreneurs, a lot of investors as well that can help you with your first introduction to the investment landscape. And if you want to learn more about this, you can, of course, reach out to me, and we can have a cup of coffee digitally and continue a conversation on how we can help you and get you funded. So that is, in short, my presentation, Evelyn, and I hope for you guys it was not too heavy. So at the last part of this masterclass.
Thank you.
Really good. Thank you so much, Maiko. I think it is a very good add-on actually to what we've heard so far, because everyone learned on the different type of investments that you can get and when to get what. So I think the kind of theory they have now, and you actually make a nice bridge. Okay, now we know the theory. How do you actually get that and implement that in your own company? Are there some people who have some questions for Maiko, or? I will put his email address. I will actually send you an email as well with a slide deck, because if we close this call, then we'll lose the chat, and then I can put his email address in that email as well.
Yeah, I would like to have the deck because I really like the slides. It's nice to see, because this is exactly the theory that we work with and help entrepreneurs to get ready with. So yeah, it was nice to see.
Exactly. Are there some questions now or last things that you want to voice?
Yeah, Evelyn, I have a question. What's the difference then between what's Maiko and his team doing and the Investment Ready program, for example, at Impact Hub?
It is, to be honest, I cannot really answer that because I'm not so much in the Investment Ready program involved. No, I cannot enter it, to be honest. I can make up a question, or I can make up an answer, but I just don't know.
I can give it a try. I work with your colleagues as well, Evelyn, with Romee and some other people. So we are really in the next step for those people who who join to the investor readiness program. So what we see, we get a lot of entrepreneurs who've been in that program. They come to PIM, and we see that it's a great preparation for getting actually into the funding landscape. So PIM is then the next step to actually get that financial strategy and get the first conversation with investors and do that matchmaking and deal closing. Okay. Because that is the main goal of PIM, is to get you funded. That's the main goal. So it's really hands-on and really result-driven.
Really nice. Thank you so much, Michael, for answering that question.
Yeah, sure, no problem.
Is there more that you want to say or ask, or everyone is, I think, now okay, right?
Great session. It was
really
just
good.
It was a good session, yeah.
Really good. I'm happy that you're also enthusiastic, because this is it is funny, because I like to share this actually before we take off, because I think this is actually a thank you to you. Listen, I just said to Stanley, I texted him and I said, like, Stanley, you're the best. And he said, thanks for allowing me to share some knowledge. And like I said, the main people we need to thank are the entrepreneurs for taking such a risk in making the world a better place. We can only do our best to assist them in this. Good luck with the rest of the program. So it is actually that we have to thank you for doing what you do, really.
No, he's like such a great person. Like, whoa, yeah, that's really nice.
Yeah, really nice, guys. With this, I really want to close off. Thank you for being here. Thank you for doing the work you do and being part of this this community and this ecosystem. We will share the recordings later, the slides from Maiko, and let's keep in touch. Yeah.
Thanks a lot. Bye-bye.
Guys, good evening.